not too specific, but in terms of the loans out there, can you kind of describe generally FHA loan versus a conventional loan? I know conventional probably 15, 30 years, fixed variable. You kind of just describe the difference between the types of loans out there?
The difference between FHA and conventional, normal conventional, you have to put 5% down minimum. You can put more down, as much down as you want. If you put 20% down, the mortgage insurance is not there. If you put less than 20%, you're still going to have mortgage insurance, but it's monthly and there's not an upfront mortgage insurance premium. With FHA, you're going to have an upfront and a monthly. With conventional, once you put 22% equity into the loan, then the MI drops off, the mortgage insurance drops off. With FHA, it is for the life of the loan on a 30-year loan. VA is 0 down, VA loan. It has a VA funding fee that's paid up front, but it's also not paid up front, but rolled into the loan, and there's no monthly mortgage insurance on it. There's a USDA loan, and it's 100% financing. There is mortgage insurance on it. It's less than the FHA mortgage insurance, though. But the USDA are going to be for rural areas, and not all properties will qualify for that. Anything else to add? Adjustable rate mortgages. You may want to do that one a little bit more than me. I haven't done very many ARMs because there are just not too many people do those right now because the interest rates are so low. You can go ahead and get your interest rate at a low rate and it's fixed. Adjustable will adjust as interest rates start going up, so will your interest rate on your mortgage. But is there anything else to add?
That probably is the best reason right now we're not doing a lot of adjustable rate mortgages. Situations on those is if you knew that you were not going to be in your home for more than 5 years, do a 5-year adjustable. But you know what? What I've learned is no matter what we plan, that's not what's going to happen. So I'd highly recommend a fixed rate at this time.
Absolutely. And one more thing that you'll people ask about, the different fees that everybody charges. Some people don't charge an origination fee. My company doesn't charge an origination fee. There are origination charges that the government shows on your good faith estimate. That's going to be your underwriting, processing, and doc prep fees. Most everybody has those. But if you see a discount, the discount point is actually buying your rate down. So that is something that is different, and you need to ask your lender if you can buy your rate down, how much it's going to cost, and is it worth it? It's not always worth it to buy it down.
I have a 20-year-old, okay? So if I'm using my 20-year-old's income to help me with the down payment assistance, and then say next year or in 2 years, my daughter says, okay, Mom, I'm ready to, I'm finished with school, I'm ready to become a first-time home buyer myself. If her income is in with mine, then how's that going to affect her with buying her, purchasing her home?
There's two different things we're looking at there. If you're not using her to purchase your home, but we do have to count our income on the city programs. If you are using a program to get your actual loan, unless she is on that loan, she's not involved in any way. So she can go buy a home in 2 years with no problem. That help? Okay.
No. All right, so because I used to work in the mortgage department with Bank of America a few years ago, and one of the things that we talked to people about, when I actually had a gentleman that had his children's name listed on his mortgage, so even though he was paying the mortgage, it was showing on their credit. So whenever they graduated high school and whatnot, they had, I guess, good credit points. How does that work? I mean, is that something that's...
I'm going to answer it from my company, then I'm going to open it up to the panel. What we would do is get proof that you're making the payment, it's your mortgage, and that you're living in the home. Then we would not count that debt against them because they're co-signers on the note, but you're the principal buyer, you're the owner. Now, that's the way my company would look at it. Anyone else?
That's a kind of a tough one because certain lenders in certain circumstances would include that liability, even though it helped their credit. Now they have a mortgage, so that mortgage is a $500 a month house payment. When they go to get a new mortgage, mortgage, you're counting that $500 house payment against them. Okay, and so what she's talking about is in some cases you can have documentation, cancel checks, things like that to show that you're the one making the payment. But that may or may not work depending on the specific loan product or the specific lender. Different lenders have different requirements. So for most of our loan programs, for example, that would still be counted against them as a liability, because ultimately if something happened to you, they're jointly liable for resuming that mortgage payment. So I guess on the one hand, it's a good way to help them establish some credit. I would probably recommend other ways of that. And I had one thing that someone mentioned earlier. You were talking earlier about mortgage insurance. Does everyone know what mortgage insurance is? Does anybody know what mortgage insurance is? Okay, mortgage insurance, along with your regular house payment. When you take out a mortgage, you're going to have what's your basic note payment. So if you borrowed $100,000 at 5% interest, it comes out to be a monthly payment of $100, which is right. So don't write that down. But whatever that monthly payment is. Okay, additionally, every month you will pay into basically they call it escrow. You'll pay an additional amount of money every month, part of which goes to pay your property taxes. So if you have $1,200 a year tax bill, you'll pay $100 a month. So to pay your taxes, so at the end of the year you have the full tax bill. You'll pay a portion of monthly payment for homeowners insurance. And you'll pay for it. And homeowners insurance, that's just in case you have hail damage on your roof or your house burns down. And again, whatever that annual premium is, the lender will divide that by 12, and you'll pay that much each month along with your note payment. Mortgage insurance. Both FHA and conventional loans oftentimes have a requirement for mortgage insurance. Even though you're paying for it, that's actually insurance that covers FHA or the lender in case of default, job loss, things like that. And the amount of that premium will vary based on how much down payment you have, your credit score, and the loan type. FHA requires you to pay a portion of that insurance premium up front. So you'll pay, 1.75? So you'll pay a percentage of the loan amount up front, and then each month you'll pay, let's say $50, $100 a month that goes into your FHA insurance. What that does in case something happens to you or you default, that helps FHA recoup any losses should they have to foreclose or do something with the property. Conventional works the same way, only there's generally not an upfront. FHA, you'll pay that monthly premium the whole time you have the loan. On conventional, like she said, once you pay down to like 78%, to where the balance is now 78% of the value of the original purchase price, the insurance goes away. So your house payment will drop by whatever that mortgage insurance premium was. And again, that doesn't only protect lender in case of default. She touched on, let's say your union goes on strike or you have a temporary job loss. Oftentimes those MI programs will provide stopgap coverage to cover mortgage payments and things like that in that gap. So it protects you to a certain extent, but it's protection from the lender and it's a monthly payment. So when you hear people talk about mortgage insurance, just kind of keep that in mind. That's always going to be something, if you put down less than 20%, you'll want to make sure you keep that in the back of your mind that whatever my mortgage payment is, I'm going to have this little extra bit that I'm going to have to pay along with that. And that's for your mortgage insurance and then your taxes and homeowners insurance.
Let's say that you were the co-signer, like a parent, with the primary on buying the house for you, but your name is still on the house. You lived in the house and made the payments for the house, so would that disqualify you from the first-time home buyer program?
The way that they look at a first-time home buyer on your tax returns, it's going to tell us whether or not you've got more, that you've been taking credits for interest and the property taxes. If that's not on your taxes for 3 years, you're not the owner. You didn't own the home.
Okay, so if you did claim the house though because you were paying for it,
then you're not a first-time home buyer.
Right, okay.
It's like a first-time borrower as more so, because if you're entitled to a family home or whatever, that's a little bit different than if you've taken out a loan for a mortgage for a house.
Okay.
So there are two different things. You've got the mortgage, which is the note obligation. You've got the titling, which is, oftentimes you may, like say, have two parties, husband and wife, or father and child. Dad has the mortgage, but to make sure that the child has, for estate planning purpose, they put the child on the deed of trust, on the title of the home. So if something happens to that parent, the child is on title of the property. That's different from borrowing in the mortgage, so whether or not that person's taking on a mortgage. You can be on the mortgage and not be on title. You can be on the title and not be on the mortgage.
Okay,
Unless you're married in most cases, then in
No,
Texas you gotta
it's
go.
my dad and I, but I think I'm on both, and it appears on my credit report, so I was thinking.
Yeah, if it's on your credit report, then you're on the mortgage.
Okay.
But there are cases where you may, as a child, get, sometimes parents will quit claim for their, part of their interest in the collateral, the deed to their children.
So when he was talking about the payments and it going toward the insurance and toward the principal and interest, whatever. So whenever you're, and this may not be the form for this question, but if you're paying, the people that I know that own homes, they say they pay an extra payment each month, each year, at the beginning of the year or in the middle of the year, whatever. What is that? Is that extra payment being split among those things, including the homeowner's insurance? Or
No.
is it going
No, those,
So you need to let your lender know that's to be applied to principal. Otherwise, yeah, it will be applied to the other stuff. Or maybe just get put in your escrow account. A lot of times they'll get it, and if you don't indicate, most lenders have a hierarchy. If they get a check, they don't know what to do with it. First and foremost, they'll go to any late charges you owe, or any other charges against the loan that you've incurred, and then it may go to escrow and on down the line. So just make sure you indicate, usually when you send it, they'll give you a little slip to put it on there, or just better yet, go into your lender and say, apply this to principal. Same thing applies if you're on a bi-weekly, and that works in that you're making a payment every 2 weeks. So essentially, you'll be making 26 installments, which is the equivalent of making 1 year plus 1 monthly payment. You just need to make sure that you let the lender know that those overages are for principal curtailment, what they call curtailment, to principal application. Otherwise, they will just put the extra to whatever their hierarchy indicates.
I want to add one thing. Just going back a little bit to you're on a title. If you have gone through a divorce and your spouse got the house in the divorce and it says that on the divorce decree, you can still qualify for some of the city programs as long as you can income and credit qualify.
Just got
I just need some clarification, just to make sure. You're talking about the mortgage insurance, the homeowner's insurance, it's all one check, right?
Yeah, you just make one check for one payment. But a lot of times folks don't realize is, okay, my note payment is, like $300. Well, then all of a sudden they realize their monthly payment is $500. Well, and especially like if you live in Tarrant County where they've got pretty high property tax rates, for example, your monthly property tax payment may be more than the note payment on your house. So you just got to make sure that when you're thinking about what can I afford and what is my payment going to be, that it's not just going to be the payment on the note. You're going to have homeowner's insurance, any mortgage insurance premiums, and property taxes that are included in that. And that makes your total monthly payment. Also, one thing to keep in mind is even though you may have a fixed rate mortgage, if your property taxes go up,
as the volume of my voice, so will your monthly payment.
Okay, do we buy an existing home? Do we buy a foreclosed home? Or do we buy a brand new home that's from a developer? That's
whichever fits your situation, whichever is best. As long as, from a lending standpoint, it's the condition of the property. And then what you qualify for. But whatever fits your situation is going to be the best for you. Okay? Do you have some? Some lenders do. She's talked about that too. Some of the lenders will make repairs on the properties that are foreclosed on, but you want to know that up front when you make that offer, because you'd hate to find out about it in the middle of it.
I recently had a property that the realtor didn't mention, or nobody knew that the property had been flipped, and the investor went in and bought that foreclosed home and renovated it and put it back in the market before the 90 days. When that happens, you have to have 2 different appraisals, and that can always, hold things back. But I thought I would mention that too. It's very important to know, especially if you know that it was sold as a foreclosure and then you see it brand new. It's important to know if it was a flipped home. There's a lot of restrictions with that.